Good morning, students. Today's topic in business studies and economics is break even. This is very important and somewhat technical topic. So concentrate yourself. Break even is the topic for today. Break even's definition is this is the level of sales needed for the total cost to equal total revenue. This is the definition of the break even. Break-even can be worked out by either using a formula or by drawing a graph. The formula for the break-even is break-even level is equal to fixed cost over contribution. And the formula for the contribution is sale price per unit minus variable cost per unit. So we have placed this formula in place of the contribution. Fixed cost will remain as it is. So formula becomes fixed cost over sale price per unit minus variable cost per unit. Another name for this thing, yani mean sale price per unit minus variable cost per unit, is contribution. Now we are going to study a case study. This will make your concepts more clear. So now concentrate yourself. Oldie Pine Limited makes and sells reproduction pine farmhouse tables. The cost of the reclaimed pine is £35 per table. Wages are £15 per table. Fixed cost were £16,250 per year. The tables are sold at £115 each. Calculate the quantity of the tables that must be sold to break even. So, from the case study, we have fixed cost that is 16,250. Variable cost is 35 plus 15 is equal to £50 is the variable cost, because 35 is the cost of the wood and £15 is the wages per table. So that's why this is £50 per table is the variable cost, and the sale price per table is 115. Now we are going to put the break-even formula, that is fixed cost over contribution. Contributions formula is sale price per unit minus variable cost per unit. Fixed cost will remain as it is. Now we are going to put the values in the formula. Fixed cost is 16,250 divided by bracket start, sale price is 115 minus variable cost is 50, bracket close. First we will solve this bracket. 115 minus 50 will be equal to 65. So 16,250 over 65 will be solved on the calculator, will give us the answer, that is 250 tables per year. So this is the level which will give us break even, at which no profit, no loss will be occurred. So we have find the break even level by using the formula. Now we are going to solve the same question by using a graph. So first we have, for break even can be plotted on the graph by first completing the table. So first we will complete the table, that is sales 0, 50, 100, 150, 200, 250 and up to so on. Fixed cost will remain same, that is 16,250 each for every level of the production. Variable cost is £50 per table. So when production is 0, no variable cost will be occurred. For 50, so 50 multiplied by 50 will be equal to 2,500. 50 multiplied by 100 will be equal to 5,000. 50 multiplied by 150 will be equal to 7,500. 50 multiplied by 200 will be equal to 10,000. 50 multiplied by 250 will be equal to 12,500. Next is the column of the total cost. Total cost is equal to fixed cost plus variable cost. So 16,250 plus 0 will be equal to 16,250. 16,250 plus 2,500 will be equal to this. This plus this 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 equal to this. Next column is of total revenue. When no table is sold, total revenue will be equal to 0. Sale price is 115 pound. Keep this in your mind. When 50 tables are sold, so 115 multiplied by 50 will be equal to this one. 115 multiplied by 100 will be equal to 11500. 115 into 150 will be equal to this. 115 multiplied by 200 will be equal to this. 115 multiplied by 250 will be equal to this. Now, we are going to draw the graph paper. Remember, that is very important. Output will be taken on the horizontal line. Cost, revenue and profit will be taken on the vertical line. So, we will plot some values on the vertical line, that is 5, 10, 15, 20, 25, 30, 35. These all values are in 1000. And on the output, that is horizontal line, we are plotting the values 50, 100, 150, 200, 250 and 300. And we are drawing the lines now on the graph paper. Fixed cost will be a horizontal line, that is actually 16,250. So 16,250 will be the point, and at this level, at this point, a horizontal line will be drawn, that is fixed cost. Total cost is actually, this is the total cost, that is starting from 16,250. So the 16,250 will be the initial point, and from there that line will be drawn. So look here now, 16,250 is the initial point, beginning point of the total cost line, and we have plotted the values accordingly and then join the points with the help of the scale. So this is the line for the total cost. Total revenue line will be started from 0, and these are the accordingly point 0, 0, 50, 5750, 100, 11,500 and up to so on. So total revenue line will be started from 0. Points will be plotted on the graph paper, and then these points will be joined with the help of the scale. This is the line of the total revenue, where the total revenue line and total cost line will intersect each other. That will be the break-even point, that is this one. So the point is 250 tables per year. So this is the point, 250 tables per year, and or from here we can find the dollars, that is the break-even point. We will give the answer according to the requirement. Okay, next topic in the lecture is advantages and disadvantages of the break-even analysis. This is very important topic which normally comes in the paper. It is simple to conduct and understand. So these are the advantages. It shows profit and loss at different levels of the output. It can cope with changing circumstances. For example, the following changes in the business environment can be shown in a break-even chart. Okay. Next, we are going to discuss factor, its cause and effect. First, we are going to discuss the internal factor, that is employing extra sales staff, its effect will be fixed cost rise. So total cost rise and break-even point also rise. Next factor which we are going to discuss is price increase. Its effect may be revenue rise more steeply and break-even point falls. Next internal factor is automation replaces direct labor. Fixed costs rise while direct costs fall. Effect on the break-even point unclear. Next factor which we are going to discuss is external factor, that is recession cuts demand. Break-even point unaffected, though safety margin is reduced. Next external factor is price war forces price cut. Revenue line rises less steeply. Break-even point rises. Next external point factor is inflation pushes up direct cost. Direct and total cost line rise more steeply. Break-even point rises. This is very important table. Okay, but there are some disadvantages of the break-even chart. However, there are many assumptions in the break-even process that may limit its usefulness. This is another very important question, another very important topic that frequently come in the paper. First assumption about the break-even chart when we make it is all output is sold. Break-even works on the basis that all output is turned into sales revenue. In reality, firms will have stocks of the unsold items at any one time, unless they can work on a purely just-in-time basis. So this is the first assumption that we make about the break-even analysis. And other assumption about the break-even analysis is one product and price. Most businesses sell more their products at different prices in different markets and to different customers. Customers who buy in bulk, for instance, will be entitled to a discount which is not considered in the break-even analysis. Break-even ignores all economies of the scale. Rather, we get economies of the scale when we produce things in bulk. Next assumption is that we make about the break-even analysis is straight line cost and revenue curves. If a firm is forced to adopt lower prices at higher output because the market is becoming saturated, then the revenue curve will not be a straight line. Mind it. Similarly, firms' average variable costs are likely to be lower at higher outputs as it can negotiate a discount from its suppliers. This thing is also not considered in break-even analysis. This is the assumption. The straight line assumption also means that semi-variable costs are assumed to be directly proportional to output and in essence are just lumped together with other variable costs. In fact, the term semi-variable cost is not used at all in the break-even analysis. Next, drawback in the break-even analysis is a static model where variables change independently of each other. In reality, the business world is dynamic, and any increase in the output and any change in the cost is likely to impact on the price levels. Break-even, like a balance sheet, is only a snapshot of the situation at a particular point. Increasing shortage of the energy, for example, will result in some significant increases in both variable and fixed cost. Next drawback in the break-even analysis is not all the costs can be easily classified as fixed or variable. Another drawback in the break-even analysis is the result is no more accurate than the accuracy of the original data it is based on. Next drawback is it ignores all factors other than cost and revenue. There are more factors are also there. Production is also affected by the availability of the finance, people and management influences, competitive action, etc. For example, maximizing production may place excessive pressure on the staff and may require existing employees to work overtime, so changing the cost base. Next drawback is reactions of the competitors. Break-even analysis ignore the fact that competitors may change their product and or price that will affect your business as well. So these are the drawbacks in the break-even analysis. Now we are going to discuss some important formulas. Average cost is equal to total cost over output. The formula for the total cost is fixed cost plus variable cost. Output will be remain as it is. So this is the formula of the average cost. Next formula is of the profit. Total revenue minus total cost. Next formula is of the loss. Total cost minus total revenue. Next formula is of the break-even level. That is total cost is equal to total revenue. Next formula is of the break-even point, fixed cost over contribution, and the formula for the contribution is sale price per unit minus variable cost per unit. So fixed cost will remain as it is. So this is the formula for the break-even point. And the last formula is total revenue is equal to sale price of the product multiplied by quantity sold. So these are some formulas. So this was the topic, students. This is very important topic. So read this lecture again and make your notes. Thank you so much.